Hello and welcome to Crossing the 49th, a cross-border tax and financial planning podcast. I'm your host, Phil Hogan from Beacon Hill Wealth Management. Today we're going to talk about RRSPs for those that live in the U.S. Okay, so today we're going to talk about RRSPs for those that live in the U.S. So I'm going to assume that if you're living in the U.S., you're not a Canadian tax resident. You likely were in the past, and you're a U.S. taxpayer, either a U.S. citizen or a U.S. green card holder. So this topic we're deferring quite a bit from our most kind of popular topics here. I tend not to write a lot about Canadians in the U.S. or non-Canadian issues, but this is a good one. I think, in the future, I'll be writing some more stuff and doing some more videos on moving to the U.S. from Canada, because, we do get a lot of questions about that. Okay, so let's get into it. So American residents with RRSP. So why would you have an RRSP if you live in the U.S.? In most cases, that's because at one point in time, you were living in Canada, working in Canada, and you contributed to an RRSP. And at one point, then you move back down or you move to the U.S. So now you're in the U.S. and you still have that Canadian RRSP. Now, most U.S. advisors are not able to manage an RRSP from the U.S., so you'll likely have a Canadian broker or investment advisor handle the RRSP for you in Canada that will be managed in Canada. So managed in Canada by a Canadian advisor, and you still now live in the U.S. So we're going to talk about the implications of having this RRSP and what are those implications for both Canadian and U.S. purposes. Okay, so let's first start with the discussion of the treaty. How does the Canada-U.S. tax treaty treat RRSPs for Canadian and U.S. tax purposes? So under Article 18 of the treaty, and I'll put some links down below to an article on the subject and the treaty. So under Article 18 of the tax treaty between Canada and the U.S., which includes a bunch of other items, not just RRSPs, but RRSPs are tax deferred both for Canadian and U.S. tax purposes. So to the extent that you contribute and hold assets or investments within an RRSP, they're deferred for both Canadian and U.S. purposes. When you contribute to an RRSP, however, you get a tax deduction up to a certain limit amount on your Canadian return, but you don't get that same tax deduction for U.S. purposes. We're not going to get into the intricacies of how RRSP contributions are claimed for both Canadian and U.S. purposes, but just know you don't get a deduction for RRSPs in the U.S. So in most cases, you'll have a situation where individual has an RRSP in Canada, living in the U.S., and they're really just trying to plan for eventually how do they take this money out. And that'll be kind of the bulk of the conversation today, is you start getting to a point where either you need the money or think you want the money down in the U.S. What are the implications? And then you get closer to retirement. What are those implications? Before we get to the implications of withdrawing funds from an RRSP, let's first talk about some regulatory and kind of compliance issues related to foreign accounts. So as we know, if you as an American citizen or American taxpayer, if you have accounts outside of the U.S., foreign financial accounts outside of the U.S., you're required to report those accounts on an FBAR and maybe an 8938 form. So just know that an RRSP is no different. RRSPs will need to be included on FBAR accounts and 8938 reporting. The 8938 is a form very similar to the FBAR that's included in the tax return. It has a higher threshold limit than the FBAR. FBAR, if you have aggregate total highest balance accounts over 10,000 USD, then you have to file the FBAR. So in most cases where individuals have accounts outside of the U.S., they'll have to file an FBAR. So don't forget, very important, FBARs have really high penalties, although we tend not to see those penalties for, kind of everyday people, but you still want to file these forms on time every time. Penalties are ridiculous. So make sure to include your Canadian RRSP on your FBAR filings every year. In most cases, your RRSP is going to be over 10,000. So that by itself will likely just trigger an FBAR filing on its own, even if you don't have accounts outside of the RRSP. Okay, so outside of disclosure and foreign asset reporting, what happens when you withdraw from an RSP? So in a situation where an individual, and I'm going to assume that this individual has not yet reached the age of 71, and we'll talk about the implications of that in a little bit. The actual non-resident withholding rate on most income in Canada is 25%. So without reviewing treaty rates, if you were to withdraw income from an RSP or any amounts that weren't reduced for treaty purposes, your withholding rate would be 25%. Now, under the treaty, lump sum amounts from RSPs don't get a reduced rate of withholding. Therefore, you're going to pay 25% on any withdrawals from your RSP to the U.S. So the way this would look is, let's say you had an RSP in Canada and you live in, let's say, Florida. So you withdraw $10,000 from your RSP. The bank or the investment advisor, whoever holds the RSP, knowing that you're a non-resident of Canada, will withhold 25%. That 25% will get sent to CRA, the Canadian government, and that'll be your final tax. So assuming the correct amount of withholding tax went down, that'll be your final amount of tax for Canadian purposes. You'll then take that $10,000, you'll convert it. Now, let me just preface this a little bit. There are cases where your RSP will have a cost basis for U.S. purposes. We're not going to get into that, but there are some situations where if you're moving from Canada to the U.S., you might have some cost basis that you can claim. But assuming that's not the case, the $10,000 amount gets converted to US dollars. So let's say that converts to US dollars to $7,000. That $7,000 is included on your US tax return, and tax is calculated on that amount. Now, assuming you didn't do anything after recording the amounts on your 1040, you would pay tax twice. You paid 25% to the Canadian government, and now you've paid, and let's say you paid, 20% on your US return. You now have paid 45% tax on that RSP distribution. And people don't think that's possible. We've seen that often on tax returns that are often prepared without the use of a competent cross-border advisor, because you might receive the distribution and pay the 25% and you'll kind of forget about it because you received your cash, and then the next year you do your tax return and you pay another 20%. As time goes by, you might not remember that you paid an additional 25% Canada, so you're paying 45% on that amount. So obviously that's incorrect. So the way to handle the distribution on the U.S. side is you tax it like we talked about. You pay 20% in the U.S. You get a credit for the tax you paid in Canada. Now, you don't get a credit for the whole 25% because the way foreign tax credits are calculated, and to calculate foreign tax credits on your U.S. tax return, use Form 1116, and you use Form 1116, and there's different versions of that form. There's a general form, which would include things like RSP distributions. There's a passive form, which would include investment income. And then there's a resource form that we would also use to resource amounts based on the treaty. So use Form 1116 to claim a foreign tax credit on your U.S. return for the Canadian taxes that you paid, being 25%, but they will be limited to the lesser of the amount that you paid, 25%, and your U.S. tax on that RSP distribution, being 20%. So you will get a foreign tax credit for 20%, which means you effectively won't pay any U.S. tax on that RSP distribution, which is great. But you've also already paid 25%. So overall, you paid 25%. You paid 5% more than your actual U.S. marginal rate, which is often what we try to kind of plan around for. And I'll talk about that in the next section here. But the key here to remember is you're going to get a tax credit for the lesser of that amount. So lesser of the amount that was withheld and the amount that's calculated for U.S. tax purposes. If your U.S. tax rate was 30%, the lesser of 30%, 25% is 25%. So you'll get a credit for the full amount of Canadian tax. So in a nutshell, that's how foreign tax credits work for those distributions. Now let's talk about some options here as we get closer to the age of 71. So in a lot of cases, especially given we have income splitting in the U.S., like we don't have in Canada, rates tend to be lower federally, or not tend to be, they are lower federally. Brackets are much higher. In a lot of cases, your marginal U.S. tax rate is going to be less than 25%, which you don't want to withdraw anything at more than your marginal rate because you're going to pay that extra amount of tax. Like in the example before, we saw that we had a marginal rate of 20%, but we ended up paying 25% overall. So that's something we kind of want to plan out for. So what'll happen is when you get over 71 years old, in Canada, your Canadian broker will convert the RRSP to a registered retirement income fund called a RRIF. That's the acronym. And the reason they do that is because if they didn't have a mechanism to convert it to, and they're essentially converting it to an annuity, to convert it to an annuity, then you could continue deferring tax on the RRSP indefinitely. And of course, they gave you a deduction early on in the process for holding and contributing to the RRSP. But at one point, they're going to want their tax. And this is how they get their tax, they being the Canadian government. So the account gets converted to a RRIF, and we won't get into the calculations here, but essentially, over a period of time, you're required to withdraw money from the RRIF every year, and that'll be taxed for both Canadian and U.S. tax purposes. Now, the difference here is under the treaty, we didn't have a reduced rate for RRSP distributions, but we do have a reduced rate. So, in the previous example, those would be lump sum distributions considered lump sum. Once it annuitizes, under the treaty, they say periodic payments can get a 15% withholding rate on the Canadian side. So now we've gone from a total tax on the Canadian side of 25% all the way down to 15%. So let's see how that plays out. So for U.S. purposes, your rate is still 20%. When you get your RRIF distributions, the withholding rate on that amount will be 15%. So now when you calculate the foreign tax credits on your U.S. return, you will have a 15% tax as a credit, which will reduce the 20% tax you already paid on the U.S. return. You'll have 5% extra, but at the end of the day, it doesn't really matter because your marginal rate in the U.S. was already 20%. So as long as you don't have a withholding rate above 20%, then essentially you're paying U.S. tax rates on that RRIF payment. So that's one of the reasons why we like to wait till the RRIF is annuitized before we make a payment to clients for their RRSPs, those that live in the U.S. Now, sometimes you can avoid it. Sometimes somebody needs the money and they want to pull the amounts out. Or in some cases, the RRSP is such a small account, let's say it's like a $10,000 account or even a $50,000 account. Sometimes you just kind of suck it up, pay the tax, and then close the account because it's likely not worth managing. So in some cases, you will just pay that 25% and then move on with life. But if, for a lot of our clients, their RRSPs are, well over $1 million, sometimes, even, of course, over $2 million if they've been saving for some time. So we don't want to, pull $2 million out at 25%. We want to wait till it annuitizes. And then, of course, on the Canadian side, once that RRSP gets distributed to a beneficiary to a spousal beneficiary, it rolls over tax-free. So you can continue to defer the RRSP to a spouse indefinitely until that spouse passes away. Then there'll be final Canadian tax. That's not the case, though. Unlike IRAs in the U.S., it's not the case for non-spouse beneficiaries. So your RRSP goes to a non-spouse beneficiary. There isn't a rollover. There's immediate taxation upon death on the Canadian side, different in the U.S. because we have a state tax. So that's really important to know. We'll get deferral as a rollover to a spousal beneficiary, but for non-spousal beneficiary, you'll have full taxation in Canada. Now, we'll talk a little bit about some options here when we go back to having to pay 25% on RRSP distributions. This is not very common, but I always mention it to clients or prospects when we chat. There is a relatively unknown section in the Act and a special tax return that you can file in Canada to reduce the amount of non-resident income that you have paid to you. It's called the Section 217 return. I'm not going to get into the intricacies and the complexities of that filing, but essentially, if most of the income that you're receiving is from Canadian sources, so let's say you don't have very much income at all in the U.S. and you want to withdraw $50,000 from your RRSP, and that withholding rate will be 25%, you have the ability to tax that full amount on the Canadian side at marginal Canadian tax rates, which will likely be much lower than 25%, and reduce it 25% down. So I'll just leave that there. That is an option for those that don't have very much other worldwide income, and most of the income that they're receiving for that particular year is going to be in the form of RRSP distributions. So, that's a general overview of what it would look like to receive distributions from an RRSP as a U.S. resident. Remember, most U.S. RIAs and investment advisors cannot hold these RRSPs. So it's important to have a, competent cross-border advisor, investment advisor, and then, of course, a competent cross-border tax team to help you with these filings. Because on the surface, they might not seem like a lot, but, in the past, we've dealt with many situations where, incorrect withholdings were made, especially when incorrect withholdings are made on the Canadian side. They're much more difficult to correct than if they were made on the U.S. side. On the U.S. side, relatively straightforward. We can file, 1040 NRs. But on the Canadian side, it's much more difficult. So I'll leave it there. I hope that's been helpful. If you're somebody that needs help with your investments on either side of the border, please reach out. There'll be a link to a free consultation below. Big thanks to everybody that's supported the channel. If you're not yet a member of the Americans in Canada group, great community, almost at 10,000 members currently. So make sure to sign up there. Make sure to check out the blog. We always post new content, getting back on videos now for the YouTube and podcast channel. So big thanks to everybody for their support, and we'll see you on the next one.